Hello and welcome to Energy Insights. Today we are breaking down the various forces shaping the global energy markets from crude and LNG to electricity demand and power sector dynamics. Today we will analyze the latest price movements, supply trends, and equity performance, providing data driven insights for investors, businesses, and policymakers. So, overall, we are covering the global energy market analysis, starting with the first segment of AI power demand. Then, under the segment 2, we will look to the LNG flows, and then the oil trends, and the last segment would be the equity performance of energy companies. So, overall, in this episode, we explore four key areas: the impact of AI on the power demand, developments in the Strait of Hormuz, global oil and gas pricing, and performance of major energy companies. So, let's dive into segment one, which is the AI and power demand dynamics. So, let's begin with the segment one, examining how artificial intelligence is reshaping electricity consumption. The rapid expansion of the artificial intelligence, normally we call AI, in the large-scale data centers is significantly increasing power demand, with energy usage in some of the regions revolving at the medium-sized cities. High demand is concentrated in the United States, Europe, and Asia, where cloud computing infrastructure is dense. Utilities are responding by diversifying energy resources. Natural gas provides firm, flexible capacity. Renewables support sustainability targets, and the nuclear offers carbon free baseload energy. However, concentrated AI activity is creating global stress, indicating potential bottlenecks in electricity reliability. What are the implications? The implications are that the transmission and storage system must be upgraded to handle peak loads. Electricity pricing may become more volatile in high demand regions, affecting industrial and residential consumers alike. With the AI impact on the power analyzed, let's move to segment 2 to look at the global shipping developments in the Strait of Hormuz. So, segment 2 focuses on the Strait of the Hormuz, a strategic choke point for the global energy flows. The first Western European vessel transit since regional tensions began signals a potential easing of supply disruptions. The strait remains crucial, transporting roughly 20% of the global energy. Even partial normalization reduces premium freight costs through geopolitical risk, continue to support a risk premium in the oil pricing. Market interpretation shows that these limited movements directly affect short-term tanker rates, influencing shipping costs for oil and LNG worldwide. Having assessed shipping risks, now we are turning to segment 3 to examine the oil and gas and the refined products market trends. So, segment 3 analyzes commodity prices and market segments across crude, natural gas, and the refined products. So, crude oil prices are moving sharply. WTI is trading at around $111.54 dollar per barrel, which is an increase of 11.41%, largely due to the Middle East supply risk. Brent crude is at $109.03 per barrel, rising 7.78%, reflecting the European exposure to the Strait of Hormuz. Similarly, the OPEC basket is at $110.63 per barrel, slightly down over 3 days, reflecting its average composition. Natural gas markets show regional divergence, like in case of the Henry Hub, it's traded at $2.80 per MMBTU, relatively stable due to the sufficient inventories. Similarly, TTF dropped to 16.22 euro per MMBTU, easing supply tension. Similarly, in the case of the JKM, the Asian LNG traded at $19.83 per MMBTU, reflecting ongoing regional demand pressures. Refined products are also seeing price movements. Gasoline traded at $3.29 per gallon, which is up in the price in comparison of yesterday's by around 6.36%, while heating oil reached $4.36 per gallon, which also show upward movement of 7.5%, driven by seasonal winter demand in the northern hemisphere. The market takeaways are that the oil prices remain heavily influenced by the geopolitical risk premiums. Natural gas markets differed by region, with Europe seeing relief while the Asia stays tight. Refined product prices respond both to the crude markets trends and inventory levels, which affect the transportation and the industrial sectors also. With this segment 3, where we analyze the commodity, let's move to segment 4 to assess how these trends are reflecting in the energy, particularly the oil, LNG, and the power stocks. So segment 4 evaluates equity performance across oil, LNG, and the power sectors. Integrated oil and energy companies show varied reactions to the market condition. ExxonMobil is trading at $160.69 as a face value of its stock, nearly flat as investors take profits. So Chevron is at 198, almost $199, because $1,898.97, which shows an upward movement of 79.79%, benefiting from the rising the crude prices. European majors like Shell and the British Petroleum also showed upward moment of 1.16% and 2.06% respectively, reflecting investors' confidence amid energy security concerns and LNG exposure. LNG exporter like Chevron Energy traded the stock price remained $281.16, which recorded an increase of 1.93% in comparison of yesterday, supported by the strong European and the Asian demand. Power and utility equities are also moving steadily. In the case of Next Extra Energy, share traded $92.57, which is an upward 0.95%, driven by rising electricity demand from the AI infrastructure. Duck Energy traded at $95.48, which also showed upward movement by 0.72%, supported by the dividend stability and the regulated operations. In the Middle East, Saudi Aramco traded at $27.60, which is a little slightly down by a figure of 0.36%, showing a minor correction while fundamentals remain robust. So the key insights of segment 4 are that the energy equities track commodity price movement and geopolitical risk premium. Power and utility stocks show steady gains due to structural electricity demand growth. Investors are increasingly valuing companies balancing commodity exposure with the clean energy growth opportunities. So that concludes today's in-depth analysis, from structural power demand shift driven by AI to LNG flows, refined product prices, and the equity performance. Energy markets remain interconnected and complex. Stay tuned to Energy Insights for the next analysis, where we will continue to provide actionable insights from the global energy markets. Understanding the data is key to making informed for energy decisions. And thank you for watching Energy Insights.